All right, so here we go. All right, so thank you for joining us today. So we are going to be talking about credit, debt, and saving, as you know, as we had started the event off. So today we're doing a combined conversation between Tenbridge Partners and then our company here, Insight Strategies. So we're going to start by talking a little bit about our businesses and what we do, and then we'll go ahead and we'll get into the presentation topics.
Yeah.
All good with it.
Thank you, Ivory. So I'm Sarah. Nice to meet you, and thank you for tuning in today. I've worked at Tenbridge for almost 5 years now, and my current role, I'm a paraplanner, and so I do all the behind-the-scenes work when it comes to financial planning. And it's just been a pleasure being able to work with the team at Tenbridge for the last almost 5 years and being able to serve our clients every day. They really truly make it a worthwhile way to wake up every single day. And so I really appreciate both my team and my clients. And so I'll go ahead and tell you a little bit about Tenbridge Partners. So our main mission is to guide people to confidence and clarity in their financial lives. And the way that we do that is by offering comprehensive financial planning. We believe that there's more to life than just planning for retirement. And so we try to make it our priority to make sure that we cover everything from, college savings to helping with estate planning and everything in between, because, you want to be able to enjoy your life, and there's more to life than just retirement. We do also believe that financial planning is for everybody. We do not think that it's just for wealthy people. And as a result, we offer many different payment options and different services so that it can be accessible to everybody. We are an independent registered investment advisory firm, also called an RIA. And what that means is that we're kind of like our own boss. We do answer to the SEC, but we don't have any other big boss or big company. And so that allows us to be 100% committed to our clients 100% of the time. And we really take pride in that. We are also fiduciaries, which means we are legally bound to put our clients first and always act in their best interests. And the fiduciary standard is the highest standard in the industry, and we definitely take pride in that. So enough about myself and Tenbridge. I'll let Ivory introduce herself a little bit as well. Oh, Ivory, I think you're muted.
Thank you, Sarah. So my name is Ivory. I own Insight Strategies Credit Repair. So we are a credit repair organization. Our goal is to solve issues that were caused by different life experiences. So for some of our clients, they have faced a time of job loss or a medical issue, divorce, or just general not understanding credit, because we don't get a lot of education about credit and how it works, and we're expected to enter the world and just miraculously know everything that has to do with finances and credit. That's just not the reality. So our goal is to help people with resolving any of these issues that tend to linger on the credit report, because although we may try to move on with our lives, sometimes things just stick. And what we want to do is help people to remove that damage so they can move forward, not just emotionally, but also move forward when it comes to that report card that is our credit. We also focus on helping people establish credit. So if someone doesn't have history showing on their credit report, they haven't had credit cards or any type of loan or credit extended to them, we will help them in establishing that or building that report, so that way lenders are willing to extend credit to them in the form of mortgages, auto loans, personal loans, and everything in between. So our focus is a bit different than a lot of other credit repair organizations, where with many other organizations, there's not a lot of education on what can be done to add positive history back onto the credit report. Most organizations focus just on how to remove information. We think that's a huge chunk that's missing in the industry, and it's a huge piece of the process that needs to be considered when someone is trying to improve their credit scores. If you just remove information, you don't replace it or add good information, unfortunately, you can only get so far. So again, our main focus is on that credit education aspect, and that leads me really into the next piece here, which is our partnership with 10Bridge. So 10Bridge Partners and our company Insight Strategies have partnered within the last year with our goal of bridging the gap between the credit optimization side of the industry and financial planning. Financial planning is largely focused on, of course, the assets, of course, how to grow wealth and how to be financially savvy. And I'm sure you can chime in and add more to that, of course, Sarah. But part of that balance sheet that is worked on as part of a financial plan is, again, that debt side and understanding credit. And if we can leverage that part of the process, we can make someone even that much more financially successful. And we really just realized there's a missing bridge or a missing link in the industry between learning how to budget, learning how the basics of how to save, and then transitioning to actually building that strong wealth over time. So our goal is to, again, make that gap, I guess, get rid of that gap, if you will, and work together to help both of our client bases become one type of client base. Feel free to add anything there if you'd like, Sarah.
Yeah, no, I think you covered it. You know, I think like 10Bridge, we really try to focus on comprehensive financial planning, like I mentioned, and you know, our partnership with Insight Strategies really just helps to solidify making sure that we hit every single point on a person's financial checklist. And we have a concept called your financial health checklist. And so I think that credit definitely is one of those points. And I'm really excited to be able to partner with Insight Strategies to make that happen.
Awesome. So we wanted to start by first talking about the agenda, just what we're going to be going through in the rest of the webinar. And to start things off, we want to make sure everyone knows, please ask questions as you have them. When it comes to working with you through this webinar, we do want to make sure it's interactive. We want to make sure along the way we are able to go ahead and resolve any of the questions, any of the concerns you may have, and then know that after this event, we are also willing to sit down, have a conversation with you, whether that's through Zoom, over the phone, or if you're here local. So we're going to start by looking at the best practices for paying down debt and how paying down debt impacts your credit score, so you know how to prioritize. And then we want to shift gears and start moving into the focus of saving. So how do we still save while we're paying down debt? And then from there, we'll go through how to collaborate or work with us going forward.
Hey, Ivory, just to let you know, David just lost sound. So I'm not sure if there's something on your end as the host that you could do to help with that, or if you should just leave and come back.
Try leaving and coming back. Tristan had something similar happen, and that had solved it. So let's try that. And I'll admit you right back in, David. Oh, he can't hear me. Let's try with the chat.
Oh, yeah. The meeting and come. I just sent him a message.
Okay, perfect. Okay. We'll wait for David to come back in here. Here we go. Connecting. David, can you hear us okay? I'll say it in the chat too.
I can hear you now.
Okay, perfect. Yay. Okay. Okay. All you missed was us introducing ourselves. Now we're getting into the meat of everything.
Okay.
All right. So the first thing we're going to talk about is the emotional aspects when it comes to money. So every single one of us has some sort of emotional relationship with money. So it can be very emotional for someone to see a high debt balance or feel like they don't have as much money as they did at one point in life. For some people, it's difficult to compartmentalize or keep money in multiple different types of accounts because it may stress them out and make them feel like they have quite a bit less money than they do have, for example. Or for some people, paying off debt at a slower pace may cause extreme anxiety. The association with having debt may create a feeling of a lack of security. Where similarly, not having a large amount of savings may create a feeling of a lack of security. And so someone may not want to use all of their savings or a large amount of their savings to pay down chunks of debt. When we're deciding the most appropriate approach for working towards paying down debt and how we should go about saving, it's really important to understand what your personal biases are, what your personal concerns are. So as you're making those decisions and you're putting together the plan for yourself, it's something that you can stick to, and it's something that will make sense for you personally and where you are at with your relationship with money. And it's something that can change over time as well. So just because, in your 20s, you may have felt a lack of concern for money and you felt comfortable just spending money on the things that you want, oftentimes we may see over time that the older someone gets, the more they may associate having a large amount of savings with security, because now they're thinking about things like retirement. So our role, both Siri and I, is to help people uncover what that relationship is when it comes to debt, when it comes to money, and when it comes to credit. And with understanding that, we can tailor our approach to working with you more appropriately to where you are. There's not always a one size fits all or only one solution to get to the same goal. So with that being said, it's important to also understand the logical aspects, right? Not just the emotional aspects. When considering how we want to approach paying off debt, we need to know what debt we have, what interest rates are on our debt, really just get that basic knowledge base down. So if we look at the big picture first, then we can start to narrow down our scope and come up with a plan that makes the most sense. And then, of course, we'll talk about considering the aspect of paying down debt and our credit. And so let's get into that a little bit more. How does paying off debt impact your credit? So paying off credit cards, I'll start with the credit cards, and then we're going to move into another type of debt called installment debt. Paying off credit cards can have a large impact on your credit score compared to paying off other types of debt. So that installment debt, like an auto loan, a personal loan, a mortgage, has a lot lesser of an impact on your score. The reason for this is because a credit card impacts the utilization ratio on your credit score. So really what that just means is a utilization ratio is your balance versus your credit limit. So if you have a high balance as compared to your credit limit, that can lower your credit score. So as you pay that limit or that balance down, you'll see your score correspondingly increase. An auto loan, mortgage, personal loan, those installment debts, they don't have an impact on the utilization ratio. They don't factor into that category because they're not a line of credit, meaning you can't advance money, pay it off, advance money, pay it off. Once you pay that account off, it closes. So it has a lesser impact on your overall credit score. So knowing those factors can help you decide what you may want to focus more aggressively on paying down if you're looking specifically at your credit score as your area of focus. And really what that means is you want to know what your priorities are. So if your priority is to pay off your debt with the least amount of interest, you may want to approach that differently. You may be targeting things like credit cards. A lot of times what we see for credit card interest rates is rates that are anywhere from, on the lower end, 15% up to 26%. And sometimes even 30%, 29.9. They don't go quite to 30. So if that's your goal, you may focus on first paying that higher interest rate down, but think about that psychological impact as well when you are focusing on that strategy. Because again, like we talked about previously, the emotional aspects can come into play. If you're someone who is going to derive a lot of satisfaction and more motivation from an account being paid off quickly, this option may cause your accounts to be paid off at a slower pace depending on what your balances are. If your goal is to pay off debt the fastest, then again, that could be a different type of approach. We'll look at what some of those approaches are in a following slide. And then of course, if your goal is to lower your monthly cash flow, you could be approaching that strategy completely different. You could be looking at something like restructuring your debt through debt consolidation, for instance, or refinancing certain accounts that you have. Maybe you take out an auto loan to pay off some credit cards. I mean, there's so many different combinations, and that's something that someone like Sierra and myself can help you to figure out what makes the most sense. And then if your goal is to raise your credit score the fastest, that's going to be, again, a completely different approach to the other three. The focus may then be looking at utilization. So something with high utilization, but a really low credit limit may be a bigger priority, even though it might have a lower interest rate than another debt. So the first thing we suggest is defining what your goal is, defining what your priority is. And then from there, you can start to construct an approach that you can follow consistently, rather than jumping around and starting a lot of different approaches and feel like you're spinning your wheels. So again, going into more detail, the Snowball Method, most people are pretty familiar with the Snowball Method. I think it's been more highly publicized. So with the Snowball Method, the goal is that psychological impact, seeing your debts be erased more quickly. So with the snowball effect, you start with your lowest balance debt first. And once you pay that off, then you move on to the next lowest balance debt. And what you do is you keep adding, like let's say your lowest balance debt had a $50 payment. Once you've paid off that debt, now you'll take that $50 and start applying it to that next debt. So if that next debt had a $100 required payment, now you're paying $150. So that allows you to then snowball, right? You're paying things off faster and faster, and you get that psychological satisfaction and that motivation each time you pay that debt off. And then the next one. So the next one we have is the avalanche. So this is going to be for that person who has a strong goal of, I just do not want to pay interest. I do not like paying interest. It just irks me to have to pay interest. And so for me, that's my biggest area of focus. I derive satisfaction from seeing the least amount of interest paid. And it's something you can track too. So you can still along the way get that psychological benefit from it. And then the last is the credit focus. We talked about that already a little bit. So that's just paying things in order of what's going to create the biggest jumps in credit score the quickest. A person may do this, or I've had many clients that choose this strategy when they have a goal of a specific example. We had a client with quite a bit of credit card debt, and that was the primary detractor from a higher credit score. Her goal was to refinance her house and put all of the debt she could into that refinance because she'd be paying it off at a lower rate. And she also could get a lower rate on her mortgage, and she had a lot of equity. So it made sense. But before we could achieve that goal, we needed to focus on the accounts that were going to give us the biggest jumps to get her to the score that would qualify her for a mortgage refinance. And then once we got there and she got the mortgage refinance, she was then able to pay everything else off with that refinance and see a big jump in her credit score overall. And then we could tie loose ends up at that point and focus on what else made the most sense. And we then switched gears, right? So we started with credit focused. And then we switched to what makes the most sense for us to focus on financially now that her credit's in a good spot. And that's where we begin to transition our clients over to 10 Bridge and Sierra, for example. So a lot of information so far. Does anyone have any questions before I move to the next section? Okay, I will take silence as a no. So what I wanted to do is look a little bit more in depth on these methods, Snowball and Avalanche specifically. So I know this may look overwhelming. There's a lot of numbers on the screen, but I'm going to go ahead and break this down for you. So this is a real example of what someone may be looking at when they're trying to decide what method may make the most sense for them and how it actually plays out monetarily. So I'm going to start over here on the left-hand side of the screen, the Snowball Method. So in this situation, we have an individual who in this top left-hand section, I hope you can see my mouse okay. We have a list of all of the debts, the balances of the debts, the current interest rates of the debts, and the current monthly payments of the debts. Oh, my bad. And so we have a total debt balance of $26,500, total payments on those debts of $270. This person has an extra, a little bit extra money, $230. So what they want to do is they want to start paying their debt off faster. So they're taking that excess amount of money, so total of $500 a month. When we add that $270 over here with their monthly payments and the extra money they had of $230, that's where we get that $500. And with the Snowball priority, they're now paying their debts off based on the lowest balance first. So this bottom table, if you see here, you can see it's ordered by the lowest balance first. And what we can see is how long it takes to pay off each debt. So someone following this strategy would be able to follow a table, and every month they're able to see their balances decrease. And then this will also show the total amount of interest paid. And I highlight down here the total interest simply so you can see a comparison of what may happen. So both of these options get the person to the exact same result, the exact same goal. The debt is paid off. It's not necessarily, one method isn't better than the other. It's the fact that we're getting there. That's the most important aspect. And when we make a goal, oftentimes we feel like we must do things the absolute quickest way possible. But being the fastest isn't necessarily the best. And I'll explain why a little bit more. Often what we see is when someone feels that they have no other choice, that they have to pay things off the quickest, if it doesn't match with their relationship with money, and they're sacrificing savings, and Sierra's going to get into this quite a bit more, they may end up in the same cycle where they end up taking out more debt and getting in that same situation again. So it's really important for us to understand what is our priority, what is our relationship with money, and what makes the most sense. So while this person paid only $8,400 in interest, they both were able to get there, and the difference is 5 months, just 5 months. In the grand scheme of our lifetime, 5 months isn't very long, especially if we weren't sacrificing savings, especially when we're creating this really strong foundation for overall financial wellness and financial success. So the most important aspect I would say is figuring out the plan that works for you and sticking with it. And if you try something and you think this plan's perfect, you realize it's not, that's okay. But give it a chance. And I'll let Sierra go into a lot more detail about how to structure budgeting and all of that later. Any questions about this slide? I know there's a lot going on here. So both people making $500 payments, just approaching it a different way, but both getting to the same goal of debt payoff. And again, we have our third option. That's the credit-focused debt paydown. So we talked a little bit about utilization and how that's the only thing that impacts the accounts with the credit cards and lines of credit. One of the things I do also want to bring up is when you are taking a credit-focused strategy, or really any strategy, it is important for your credit score specifically not to close your credit cards once you pay them off. If you do that, you will see a decrease in your credit score. So along with that credit utilization factor that we spoke about, if we remove the utilization, right? If we remove, let me say that a better way. If we remove, oh, our lights went off. If we remove the line of credit, we have no way to impact the utilization portion of the credit score algorithm. So let's say we pay all our cards off and then we close them. You just got rid of a huge part of what makes your credit score, and it could cause your score to decrease. Or alternatively, let's say you pay off one card and you close it, you may have now altered your utilization ratio and actually made it higher, right? Because you had one full account that maybe have 0% utilization and you have 3 others at 90% or 100%. And that just skewed the overall utilization on your credit report. So definitely keep your cards open. If it's a card you hate, you don't want it, let it close on its own from lack of use, or replace it with a different account or a credit limit increase on another card so you don't see your credit score drop. So, and then I have a factor in here again. One of the things that I think is a pretty common misconception is the dollar amount versus the percentage of utilization. So someone who has, let's say you have a credit card that has a $500 credit limit, and you have another credit card that's a $10,000 credit limit. The utilization ratio doesn't care if what your limit is. It just looks at that percentage, right? It doesn't care that one card's 10,000, one card's 500. If they're both at 100% utilization, they're both maxed out, it hurts you exactly the same way. So it can be easier to pay off that $500 card first versus that $10,000 card, right? And you get a boost immediately from that $500 card. So it's not necessarily about dollar amounts when you're looking at that credit focused debt pay down. It's going to be more about the ratios, the percentages. And then lastly, you can consider that consolidation loan. Once you do get the loan, keep those accounts open, just pay off the balances. And if you are afraid of then using credit again, if you're afraid of your credit cards, use them once every 3 months. You can keep your credit score healthy then, and then also not create new amounts of debt. Okay. And then the last thing I wanted to bring up was collection debt and your credit score. This is another common misconception we tend to come across. Paying off a collection, which is a debt, it will not help your credit score. And in some cases, it will actually damage your score further. And this in and of itself is a complete other topic when it comes to collections, how to approach them, whether you should pay them off, whether you shouldn't, how to do all of that. So today is not really our area of focus, but I do just want you to know at a basic level, if you do have a collection on your credit report, you do pay it. It may lower your score. It will not help anything like a utilization ratio. And it's best to focus your efforts on open and active accounts. Alternatively, if you have a credit card that went unpaid and was charged off, which is simply an accounting term, meaning it's gone 6 months or more past due without payment, paying that off will help. So that has to be with the original creditor, and that is simply because it's of utilization. Again, you now have a $0 credit limit and let's say a balance of $1,000. Your utilization is well over 100%. So when you pay that off, you're going to see a boost in your score. And if you have questions about anything like this, please reach out to me, and we can definitely discuss that in more detail. So from here, I'm going to go ahead and let Sierra take it away.
Thank you, Ivory. I really enjoyed what you had to say about the best practices in paying off debt and how it affects your credit. And I think that those are really important things to think about when you've got some extra cash laying around, or how to approach maybe just starting on being a little bit more financially savvy. So thank you. And then I'll go ahead and begin about where to begin on saving and investing. Perfect. Okay. So in regards to where to begin saving, you want to start with an emergency savings account. This is because emergency savings are going to be something that you'll probably tap into before retirement or something like that. And like Ivory was kind of mentioning earlier, if you do have to take out debt or possibly charge an emergency cost onto your credit card, it can end up digging you into a pretty deep hole where, as if you were to have some emergency savings laying around, it would soften the blow and make it a lot easier to navigate. So definitely begin with emergency savings. And the things that emergency savings are used for are large expenses that come out of the blue. A lot of people use them for things like vet bills, medical bills, or home repairs. And then also emergency savings are used for income loss or something of that sort. So a really good example of this was COVID-19. A lot of people lost their jobs or were laid off due to COVID-19. And if the government hadn't stepped in with pretty sizable unemployment checks, it would have been really hard for a lot of people to make ends meet. And it was really hard for a lot of people to make ends meet. So if you're able to have at least some money saved up to help pay the bills and maybe bridge the gap between the emergency that you experience and being able to, get another job or be okay because you've got emergency savings in case a big expense comes up, then it'll definitely just overall be a lot easier. And then I also want to mention that it's important to make sure you keep your emergency savings in a cash account. So you don't want this invested. You want it to be easily accessible. And so whether you keep it in like a savings account at your normal checking or your normal banking institution, you just want to be able to access it as soon as possible, because when emergencies come up, you want to be able to use it. So the golden rule, oh, sorry, will you go back? Thank you. The golden rule when it comes to emergency savings is that you want to have at least 3 months of expenses for a 2-income household and at least 6 months worth of expenses for a 1-income household. And, studies show that this is kind of a pretty good baseline to be able to cover most emergency expenses or bridge the gap between job loss and perhaps finding a new one or something else to help during that time. And then the reason that a 1-income household would want more savings than perhaps a 2-income household is because you wouldn't have the second income to help support and pay bills and to make sure that you're okay. And I also want to mention that I know for a lot of people, 3 to 6 months worth of expenses can seem like a lot, and it is a lot, but it is really important to not get discouraged and to make sure that you remember, even if you don't have 3 to 6 months worth of expenses, any amount is really going to make a huge difference in case of an emergency. So even if you've got to start small or you don't get up to that point very quick, it'll still definitely help in the long run. So once you have got adequate emergency savings put away, you'll be ready to start investing your savings. So I'll just begin talking about some retirement accounts about that that I recommend. And I typically prefer that if you've got the option to invest in a Roth IRA or a Roth 401k, that you do so. The main reason being is that those types of accounts offer a lot of different features and some really interesting things that traditional IRAs or traditional 401ks don't. And a lot of our financial plans that we run, when you invest in a Roth IRA or a Roth 401k versus a traditional account, it not only increases your value of your portfolio at the end of the financial plan, but it also typically increases your probability of success. So those are just really great accounts to take advantage of if you can. And they're also kind of exclusive in a way, because with a Roth IRA, your income caps out at a certain point and you're not able to contribute to it after you earn a certain amount of income. With a Roth 401k, not all employers offer that option. So if they do have it, it's definitely great to take advantage of it. And I want to mention that it's not that traditional accounts aren't good. You know, they are both really great accounts and they do the same thing. They get you to your retirement goal, and anything that you save into a retirement account is definitely going to help in the long run. But if you've got the option, I definitely recommend taking advantage of those Roth accounts. So if you want to be able to access a certain portion of your savings before you retire, taxable accounts, which are commonly called individual accounts or joint accounts, are really useful for this purpose. And a lot of people use them for things like saving up to put money down on a home, or for another big expense, maybe buying a car or something of that sort. And even if you didn't have any large expense in mind, they can be nice to invest in, because if you did need them or you did want to tap into them, there aren't any penalties when you take money out of it. So they're definitely great accounts to invest in as well. I will mention that it's important to think about your volatility level when investing in these accounts, especially if you're saving up for a large expense like putting money down on a home, because as that goal gets closer, you don't want to be invested really aggressively and possibly have to sell the investments in your account and take a loss. So you just want to make sure that your accounts aren't invested too aggressively when you're around that time that you're going to need that money. In terms of banks that I think are pretty good options to use, Charles Schwab, Fidelity, Vanguard, or TD Ameritrade are big banks, and they're really common in the industry. We at Tenbridge Partners use Charles Schwab to custody our clients' accounts. And personally, I think that they're a good company. I've worked with their customer service both on the advisor side and on the the normal customer service side. And I think that they are very great. I also think that the online interface is pretty easy to use. I don't have experience working with the other banks quite as much, but any of them will do good for investments. And then I guess I'll pause for a minute before I get into investments and see if anybody has any questions. And I also want to mention, if you do have a question and you don't want to interrupt or speak about it or anything, you can put it in the chat and either Ivory and I will see it and can answer it for you as well. So when it comes to investments, that gets a little bit trickier because it really depends on your personal situation, your investment objectives, your goals, and your risk tolerance. And so it's also really complicated to learn how to analyze a stock and to create a portfolio. And so it's kind of hard for me to give advice on how to invest your money, but it can be really fun to learn how to evaluate a stock. And so if that's something you're interested in doing, definitely do the research and, do what you can to learn about how to analyze it. But once your accounts start to get a little bit bigger, at that point, it's typically when people start to use an expert and have them invest and manage a larger portion of their investments. And then if you still want to do some investing on your own, you can manage a smaller portion of your investments so that you know that the larger portion of your investments is being taken care of by an expert who has done the research and make sure to review your investments and your portfolios on a regular basis. And you don't really have to worry about being either too conservative, too aggressive, or anything of that sort. I'm just going to check my notes and make sure that I touched everything I wanted to on that point really quick. Perfect. So now I want to get into some tips I have regarding saving and investing. So my first tip is that if you're the type of person who likes things to be automatic and you don't really want to have to think about, making sure that you save every month, or you just kind of want it to be something that you get used to, it's a really great idea to set up some type of direct deposit or automatic transfer into your savings account. So the way that a direct deposit would work is some employers allow you the option to put a portion of your paycheck every month. Let's just say you wanted to do $100 per paycheck into one account, and then have the remainder of your paycheck be put into your normal checking account or whatever you use. Not all employers allow this, but it can be a really useful tool so that whenever you get your paycheck, however much you have designated will go into that savings account, and it's not really something that you have to think about. And so it can be really useful. Similarly, automatic transfers do kind of the same thing. They're a little bit easier to set up, and definitely, most banks will have some type of feature that allows you to do this. The way that this would work is when you get your paycheck every month, you would set up an automatic transfer so that, maybe 5 days after your paycheck arrives, you would have a certain amount of money pulled from your account and put into your savings. So it's a similar idea. It's an automatic pull, so it's not something you really have to think about, and it makes sure that you are, making headway and saving what you want to, but might help you get used to having $100 less in your budget after you get your paycheck every month. Another tip that I have used in the past, and that I think is really great when you're somebody that struggles with discretionary spending, like eating out or shopping or whatever your vice is to implement a matching program. And you can do this dollar for dollar, dollar for every $2, whatever works for you. But the concept is that, let's say I want to go down to Starbucks and get a $5 coffee. Well, when I want to do that, I think to myself, can I afford to spend $5 on this coffee and then put $5 into my savings? And if I can, then awesome, I will go do that. And then that way I make headway in my savings. But if I can't, then that helps me make sure that I realize my limits and I don't go too overboard with my discretionary spending. My third tip is that, again, I really don't want you to be discouraged. I know that saving for things like retirement can seem like a really big, impossible goal sometimes, but it is really important to start small or just start somewhere, because any progress is still progress and it all adds up. And so to elaborate a little bit more about that and just how important it is to start as early as you can, we're going to look at a couple time value of money case studies. So the first case study, so for the first case study, we are illustrating what it would look like if you started saving $250 a month at 25 years old, which would be about 40 years of saving if you retired at 65. And we're assuming about a 6% average rate of return. So if you do that every month for 40 years, you would have about $500,000 when you turn 65 in that account. Now for our second illustration, we are going to see what it would look like if we saved the same amount, $250 a month, but instead of starting at 25, we started 5 years later at 30 years old. And so that would be about 35 years of saving, and we're assuming the same rate of return of 6%. And as you can see, we have just under $360,000 in that account when we turn 65. So what this tells us is that if you begin to save for retirement just 5 years later, you could forfeit about 30% of your potential gain in this specific scenario. I'll say that again for dramatic effect. If you begin to save for retirement just 5 years later, you will forfeit about 30% of your potential gain. In dollar terms, the $15,000 that you would have saved by not contributing that $250 a month turns into over $100,000 of lost potential gain. So, I think that this definitely illustrates that if you can afford to start early, I know that not everybody might be able to do $250 a month, but time helps. And that is the one tool that especially people who are a little younger can really utilize and use to their advantage. And so it's really important to take advantage of that because time isn't something that we can buy back. And then I also wanted to illustrate a third scenario where if we waited until we were 35, but instead of saving $250 a month, we saved $500 a month. And so in this scenario, we assumed the same average rate of return, and that got us to about $500,000, which is about the same that we had in the first scenario. So what this tells us is that in order to catch up to what we would have had in our account when we turned 65, as in the first case study, making $250 per month contributions, we would have to double our contributions by starting 10 years later. What this also tells us is that it's not impossible to reach your goals by starting later. I really want to reiterate that. Like I do not want people to be hopeless because, there's a lot of different options in order to meet your goals and to get to retirement. But if you can start young, it definitely will do you good in the long run. And so I also want you to keep in mind that as you grow older and perhaps earn more income, or maybe even you get married and you have somebody to share expenses with, it's really important to not spend all of that additional cash that you have and to put it to work for you by either paying off debt or putting it towards saving and investing. And I think the best way to stay on track and to make sure that you don't fall into this cycle is by creating a budget and making sure that you stick to it. I'll go a little bit more into detail about just how to create a budget and what that looks like. But the reason it's important is because it helps us understand just what we need every month to be able to pay our bills, have a little bit of spending money, and then whatever else is left, we can put towards savings or paying off debt. And it is also important to make sure that we track it on a monthly basis so that we stick to that budget that we had originally created and make sure we stay on track and can meet the goals that we set for ourselves. And, it doesn't have to be super complicated. You don't have to use a spreadsheet every month and create a new one. You can use online services like Mint is a really great service that might require a little bit of maintenance the first few months that you use it, but once it learns how to categorize all of your expenses into the different buckets that you want it to categorize them, it's really easy to use and a really great tool to track your spending over time. And then lastly, before we move on to the next slide, I want to reiterate that it's really important to have balance in your budget. Just like with any sustainable lifestyle or routine, you have to have balance and you have to be able to give yourself a little wiggle room here and there. I think a diet is probably the easiest way to illustrate this. If you never allow yourself to have chocolate or wine or, any of the things that you might like, then it's probably not going to be sustainable in the long run. So to elaborate into just how your budget can be built and used, I definitely recommend beginning with a spreadsheet. And I think that a spreadsheet versus beginning with something like Mint is really important because it allows you to input all of your income and all of your expenses and really see exactly where all of your money goes. And then it also allows you to create a framework about how you want to spend your money and where you want your money to go. So you definitely begin with a spreadsheet and then input all of your monthly income and all of your expenses. And this might take a little bit of time because sometimes expenses happen maybe once or twice throughout the year. So you want to make sure that you're encompassing all of the expenses, not just the ones that happened, like in November, for instance. And then once you have all of your income and expenses laid out on this spreadsheet, you want to figure out what your net income is, which is your income minus expenses. And then once you figure out what your net income is, you can put any of that net income towards savings or paying off debt. And that way you make sure that your net income at the end of the month is working towards your goals and not just something that you end up spending on whatever you like to spend it on, whether it's golfing, wine, whatever your pleasure in life is. And then, like I was mentioning a few minutes ago, using a service like Mint or even monitoring a spreadsheet, if that's what you like to do, is important to continue tracking your income and spending so that you make sure you're keeping track of your goal. And when you are keeping track of your goal, it's important to make sure that you compare what you have actually spent in that month to what I like to call the mother budget. So you want to ask yourself if you can save more or put more money towards debt that month. You want to see if you've paid off a debt and if you can use those funds to put towards another debt. And you also could probably look at if you're spending too much on discretionary items and maybe if you want to scale that back a little bit and implement tools in order to make that happen. So now I'm sure you're thinking, after all of this amazing information that Ivory and I have given you these past however many minutes it's been, you're thinking, now what? What do I do? Where do I go from here? So I hope that at least something that Ivory and I had to say today inspired you to take a more active role in being your best financial self. And I challenge you to try to implement at least one of these ideas into your daily life. And if you want a more solid path forward and you really want to get into the nitty-gritty of what your path to success and what your path to achieving your goals looks like, get in touch with us. We would love to work with you and help you figure out your path forward. And so, it's been a pleasure to speak with you today. And Ivory is going to show you a few of our tips that we recommend. And so I'll go ahead and pass it off to her.
Thank you, Sarah. That was a lot of really great information. So to wrap things up or round things off, we wanted to put together just a summary list of some top suggestions we have for success. So once you've paid off your debt, don't be afraid of having open credit. It's important to still have credit to maintain a high credit score. That does not mean you have to have gobs of debt and payments that you're consistently making. It simply means, like we talked about previously, keep lines of credit open. You just don't have to use them. And if your goal is to improve your credit score first, then again, focus on paying down those credit cards. If you're not sure how to approach that, you want a detailed plan. It's not something you feel comfortable figuring out for yourself. That's what we're here for. We can help you figure that out. And don't pay off debt at the expense of saving. So again, I'll reiterate that point a bit further. We don't want to use all of our cash flow, all of our monthly income, and put all of it towards paying that debt off aggressively, because that can be at our own detriment. If something unexpected does come up, like Sarah had mentioned, COVID-19, very unexpected for all of us, we can end up not having the resources available and then taking out more debt and digging ourselves into an even bigger hole than we started. And then develop an adequate emergency savings. I cannot highlight that enough. Like Sarah said, even if we're just setting aside a small amount of money on a monthly basis, or setting aside $5 every time we buy a coffee, or whatever that vice is, focus on that first. And that should be the primary focus before opening any sort of an investment account. We don't want to have to tap into an investment if we need access to funds, we need it right away. We don't want to be taking a loss, as Sarah said. And then know your budget. Without knowing our budget, we have no idea how much we have to pay off towards debt, no idea how much we can save, and we really have no foundation to start from. And if you're not sure how to figure out what your budget is, let us know. We can help you figure that out and give you the tools and resources needed there. And then make realistic and attainable goals. If we make goals, like let's say we say we're going to save $500 a month, but we're coming from a point where we've never saved before, then that can make that goal so much more overwhelming. So as Sarah said, start small, and then as you build that habit, I don't know if anyone's read the book Tiny Habits. Great book, but as you start that tiny little habit, it grows and grows, and you can as you increase that goal, as you start saving more and more, it feels more and more attainable. And then work with an expert to navigate your path forward. So we are all experts at something in our lives, but we're not experts at everything. And it's important to know when it makes sense to reach out to someone who is an expert, so we can lean on their expertise. They've already figured out all the problems or made all the mistakes, and we can, not have to make them. So reach out to an expert if you want help or you feel like you want to optimize your strategy. Okay, hold on. We're getting it to transition. There we go. So we wanted to go into a bit about how we help our clients. So the way we work with our clients here at Insight Strategies is we always offer a free consultation. This is really your time to brain dump. Here's everything that's going on. Here's my struggles. Here's my history. Here's what I'm trying to do. And then we find out from there, are we what you're looking for? And if we're not, that's okay. We have other resources and other people in our network, just like Sierra and Tenbridge, that can be there. Or perhaps we provide some of the services you need and the rest are provided by Tenbridge. From there, what we would do for anyone that is needing help with figuring out credit damage, we'll compile documents necessary, work directly with creditors, credit bureaus, and any collection companies on your behalf. We understand the law. We're the experts at knowing what can or cannot be on a credit report and how to fight for your rights as a consumer. They're far, far, far too often breached, far too often violated. And unfortunately, these big companies, these collection companies, these creditors, they know it. They know that consumers don't know the law, because how in the world could we? I mean, there's hundreds and hundreds and hundreds and thousands of pages of law. And our goal is to be that expert to fight for your rights. And even if you have something on your report, a debt that you know you owe, if it's not reporting accurately, if it is not valid or compliant with the letter of the law, that is something we can help you resolve. And then finally, we put together a credit building plan. So that's your step-by-step guide. What is the specific actions? What is your path that you can take with our help that's going to get you to that end goal, or build that foundation to get to that end goal? A lot of our clients are looking to buy a home, and so that's their end goal. So how do we pave that path to get there, and how do we optimize what's working really well for them, and then help repair what's not working as well as it could be? So that's how we work with our clients. We do a lot of these webinars and educational reach outs in the form of videos, emails, etc. And we will be launching some new video series coming up here in the new year as well. And Sarah, I will let you take it away.
Perfect. Thank you, Ivory. So to elaborate a little bit on how Tenbridge Partners works with our clients, we also begin with a free initial meeting to get to know you and for you to get to know us and to discuss your current situation and what path is best to move forward. And then with every client, we prioritize your financial plan. A lot of different firms can usually say that they do financial planning, but it doesn't always turn out that they really look at the full picture and really get into the nitty-gritty about what financial planning is, and give you specialized goals to get to where you need to go. So our first step is to gather all of your information and input it into your plan. And then after that, we create specialized scenarios that highlight your opportunities that you have and the threats that you have. We commonly say in and around our firm that as financial planners, it's our job that if your plan works, to break it, and if it doesn't, to fix it. And so we do just that, and we look at it all from a very large picture as well. And then our third step is that we make recommendations for you to optimize your financial well-being and to make sure that you have all of those boxes on your financial health checklist checked off, and you can sleep good at night. Good at night, knowing that you've got somebody on your side looking out for you, and that if something were to happen, that you are, you know that it'll be okay. And then we also follow up annually, and at least annually, to update your financial plan and to make sure that you're reaching your goals, and to change and update the financial plan if your goals are changing. We also like to say that the financial planning, or the financial plan, is a living and breathing document, just like us as humans. And it really is true. The financial plan that you will create at age 25 is so different than the financial plan that you'll create at age 40 or age 65. And we are here to help you along every step of the way. And then lastly, I just want to mention that we make financial planning accessible, and we really believe that it should be for everybody, and it needs to be for everybody. And as a result, we don't have asset minimums, and we make sure to offer different service and payment options so that everybody can access a financial plan if they want to. So then I think that just wraps it up. And if anybody has any questions, now would be a perfect time to ask them. And I also wanted to mention that